I want you to picture something. It's 1998. The internet is the next big thing. Tech stocks are just soaring, and everybody, I mean everybody, thinks they're going to get rich. And then, bam, the year 2000 hits. The bubble just bursts. That feeling, right? The insane hype and then the massive collapse. Starting to sound a little familiar? Well, today, that's exactly what we're digging into. We're looking at the AI boom and asking the big question, is a crash coming?
Man, the dot-com era was a wild ride. The hype built up so fast. But the crash? It was absolutely devastating. I mean, the NASDAQ index just plummeted by nearly 80%. And get this, less than half the dot-com companies even survived. So you got to remember this history because it's pretty crucial for understanding what might be going on with AI right now.
And that brings us to this, right? This famous quote, the energy swirling around AI, this feeling that it's a once-in-a-lifetime opportunity. It feels almost identical to that dot-com frenzy. So the big question we have to ask is this AI excitement a real revolution? Or are we just watching a familiar story play out all over again?
There's this great warning from the legendary investor John Templeton. He always said to watch out for those 4 words. It is so easy to get swept up in the hype and start believing that we're in some kind of new era where the old rules just don't apply anymore. But that kind of overconfidence, it can be an incredibly expensive mistake. So we have to be honest with ourselves and ask, is this time really different?
So, here's what we're going to cover. We've just touched on history's echo. Next up, we're going to break down 3 hidden warning signs that you really need to know about: the giant's gamble, the money machine, and the data wall. But don't worry, we're not just going to leave you there. We're going to finish up with a clear, actionable game plan to help you navigate all this uncertainty.
All right, our first warning sign. We're calling this one the giant's gamble. The whole idea here is that the future of the entire market, and probably your own portfolio, really rests in the hands of just a handful of incredibly powerful companies.
The concentration of power we're seeing is, well, it's staggering. Just 7 companies. We're talking Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and NVIDIA. They now make up 36% of the entire S&P 500. So think about that. Even if you think you're diversified because you own a broad index fund, you are still making a massive bet on their success in this AI arms race.
And what an arms race it is. Just look at the projected annual AI spending for only 3 of those giants: Meta, Microsoft, and Amazon. It's just enormous. Together, they're pouring literally hundreds of billions of dollars into data centers and AI models. The scale of it is almost hard to wrap your head around.
And here it is. Here's the gut punch number. You add up all the planned AI investments from all 7 of these giants for just one single year, and you get a grand total of $330 billion.
Now, to put that number into perspective, this corporate spending spree is actually larger than the entire annual economic output of a country like Finland. These companies are essentially betting the farm, and in doing so, they're propping up the entire market. The real question is, how long can that actually last?
You know, all that massive spending leads us right into our second warning sign, the money machine. Okay, this is where things get a little bit weird. A lot of the AI revenue that's being reported might not be exactly what it seems to be, and it's all thanks to this circular flow of cash that could be artificially inflating the value of these companies.
Okay, let's walk through this. It often starts with a huge investment, right? Like Microsoft funding OpenAI. But then OpenAI turns around and pays that money right back to Microsoft to use their cloud services. Then Microsoft takes that cash and buys a ton of chips from NVIDIA. And then, to complete the circle, NVIDIA invests some of its profits back into companies like OpenAI. The crazy part? Each company gets to record this as revenue, which pushes their stock prices even higher.
You know, here's a really simple way to think about it. Imagine I pay you $1,000 to dig a hole. Then you turn around and pay me $1,000 to fill that same hole back in. We can now both go and claim we made $1,000 in revenue. Our businesses look awesome on paper, but did we actually create any real lasting value? Nope. And that's the core concern with this whole AI money machine.
So the crucial point is this. You can kind of think of it like a new gold rush. You've got NVIDIA, who's selling the shovels to everybody. You've got the data centers providing the land. And you have the AI labs doing all the digging. They're all helping each other out, creating a ton of activity. But here's the catch. The massive, sustainable profits, the actual gold, that hasn't really been found yet. And you know, finding that gold brings us to our third and final warning sign, and this one could be the biggest hurdle of them all,
The data wall. The market seems to assume that AI's incredible growth is just going to continue forever, but there might be a very real physical limit to that.
Just think about this prediction for a second. It's pretty wild. For years now, AI models have been getting smarter by basically devouring every book, every article, every website out there. But that well of data, it's starting to run dry. Some experts think that by 2027, AI will have consumed pretty much everything we've ever put online. And that is the data wall.
And see, that's a fundamental difference between us and AI. We learn by living, right? By interacting with the world, having unique experiences. AI learns by being fed a static, finite library of human knowledge. So once it's read the entire library, how does it keep getting smarter at that same explosive pace? That is a huge and so far unanswered question.
Okay, so we've laid out the risks. You've got concentrated power, this weird circular revenue, and a potential data wall. I know, it sounds pretty daunting, but it really doesn't have to be. So let's dive into a clear game plan for how you can protect yourself and maybe even thrive in this uncertain environment.
So, before we get to the playbook, let's just go back to that central question one more time. After seeing all these warning signs, what's the verdict? Is this AI boom just another dot-com bubble waiting to pop?
Well, the answer isn't a simple yes or no. The signs of a bubble? They are definitely there. The overvaluation, the mania, the strange revenue flows. But there is a key difference from the 90s. Today's AI giants are real companies with real products and a much, much clearer path to actually making a profit than some company that just had a .com in its name.
So here's the core takeaway. This is your playbook. First, keep investing consistently. Set up automatic investments into a broad index fund. And, this is crucial, do not panic sell if there's a crash. History shows us the market always recovers. Second, focus on increasing your income. This gives you more fuel, more capital to invest, especially when assets get cheaper during a downturn. And third, and this is a big one, diversify.
And true diversification means not putting all your eggs in one basket. It's about spreading your money across different types of assets, from traditional stocks and real estate all the way to alternatives like gold. This mix is what acts as your financial shock absorber, and it's what's going to protect you from that crazy market volatility.
So we'll end with this. A downturn isn't the end of the world. In fact, for an investor who's prepared, it's actually an opportunity. If you understand the risks and you have a solid plan in place, you won't be the one who's panicking. You'll be the one who's ready to take advantage of the situation. So really, the choice is yours.
If you like this video, please hit the subscribe button, like, and share.